I would say if you're an investor in cannabis, you should be looking for the winners, the smartest, the most capable management teams with very strong footprints, and look at the business over a multiple year period going forward. Don't focus on the next quarter or two. Don't focus on the next year or two only. Look at 5 years out, 7 years out, that time frame. And that's how you're going to.
Welcome to Seeking Alpha's CEO interviews, informed conversations with the best and brightest CEOs in the publicly traded markets. Quality of leadership is a decisive factor in stock performance. Our show provides intimate and in-depth investing discussions with industry leaders across all sectors of the marketplace. We publish excerpts on social media platforms and the full conversations on seekingalpha.com or on our highly rated Seeking Alpha mobile app under CEO interviews.
Welcome back to Seeking Alpha. I'm Josh Kincaid, capital markets analyst, and today interviewing CEOs. My guest today is Jim Cacioppo. He's the founder, CEO, and chairman of Jushi. Jim, thanks for being with us at CEO interviews.
Thanks, Josh. Thanks for having me.
I appreciate it. Just diving right in, you guys have expanding quite a bit. Definitely not a slow day in the office over there. Your operations growing rapidly. You have a minimum 6 cultivations, 6 manufacturing, 39 retail licenses across the U.S. Maybe that's even more than when I researched this. What is driving that growth? I know it's a burgeoning industry. It's dynamic. There's a lot of states. There's a lot of overlap and redundancies as well. But ultimately, what's driving your growth?
Yeah, so what's driving the growth is, really our footprints in some really attractive states that have growing markets. We're building our business to service those markets. And that includes both retail and the grower processors, since we're vertically integrated. So in particular, if you look at, one of our stable markets that we're going to add one more store, but a more stable market is Illinois. Growing market would be Pennsylvania, where we're bringing on a lot of growth. We added a ton of stores last year to take it to the max capacity in the state of 18. I forget how many we added in Pennsylvania last year, but it was a lot. Across the country, we added, we almost doubled our store base to 28 stores last year. Most of that was in Pennsylvania. And then the grower processor expansion is really just wrapping up the construction, and the facilities moving over from the construction team to the operating team in June, and the planting starts then. And then you'll look about 90 days down the line for when the revenue starts to get generated from that grow. 60 days more or less to grow the plants, and about 30 days to process them. And then similarly in Virginia, behind that, we have a very nascent program, early program, that is growing very rapidly. Adult use has been passed in Virginia in early 2024, and it's a medical market that really now has been unbounded because they had a real backlog because of the system wasn't set up to allow the patient demand to get the patients to get cards. The legislature just did away with that as of July 1st. We have already handed over a massive expansion on that plant from construction to operations. Planting has begun, so you should see revenue coming out of the expanded facility in the third quarter. And we have a new store. That's where we're opening a lot of stores this year. We're going from our existing 2 to hopefully 6 by the end of the first quarter of 2023. So that's super exciting growth there. And then the other growth really is, more M&A driven in Massachusetts, which we did the fourth quarter of last year, at the end of the very end of the third quarter, and then the beginning of the second quarter. At the end of the first quarter, we acquired some stuff in Nevada.
I don't want to take away from that growth at all, but I am curious, with the eventuality of legalization, what's going to happen with a lot of these redundancies. You guys have focused on a lot of building multi-state portfolio. You have branded cannabis assets throughout opportunistic acquisitions. You have distressed workouts. You have competitive applications, and yet there's a lot of redundancies. So in the eventuality that there is legalization, how does one go about unwinding that or making it the best opportunity for investors and everyone, all
When
stakeholders.
you're saying redundancies, do you mean the fact that a lot of companies are pursuing similar strategies and have stores in grow processor facilities? Is that what you mean?
I mean, for example, if somebody has a facility growing in Florida, that's maybe not the best place to grow in terms of cost. You might want to grow outdoors in California versus. So there's.
Oh, yes, I see. Yeah, got it. Okay, so yeah, so in terms of legalization, let's talk about two things. Let's talk about the legalization path that would take you all the way to that point of, let's say, where you're talking to, where you could do interstate commerce, and sort of how long that might take in the process there, and then how are we positioned for that ultimately. So I would say that that process will be very slow and really not, I believe, in most investors' time frame right now, given how cheap the stocks are. So that's a worry that you might have to think about in 5 years or 10 years, but not like 2 years or 3 years, which is how I sort of look at my investment time frame as an investor in the sector. And so what you're likely to see is on a federal legalization, that you'll see some sort of Safe Banking Act plus some social equity stuff that might happen towards the end of this year or sometime next year or the year after. It's already been delayed quite dramatically. So federal's already gone much slower than the market anticipated, which is one reason why the stocks have done so poorly. Now, we've managed to grow and do really well, no matter, even without that, because we have access to banking. But the issue really for the stocks is there's a limited number of investors who can invest in the sector because we're not listed in the U.S. And that would change quite dramatically under the federal sort of legalization. There's an expectation in the market that maybe you might see it in the lame duck session or possibly for the midterms. I've never been one to try and predict that. But the path between that and interstate commerce is you probably go to something where it gets descheduled and then it becomes legal at the state level, but it's up to the states to regulate it. And then maybe the states would work together to figure out how they would do interstate commerce, or some way down the line when it becomes very normalized, sort of more like alcohol. You would see the federal sort of push interstate commerce, or some lawsuits go through appeals courts. We would expect states to protect their turf, to protect the employment level. We expect the federal government to like the state regulatory. We're in a decentralized environment, I believe, in the United States, where a lot of the local, a lot of laws are really enforced by states. If you look at education, if you look at police force, if you look at fire, if you look at state budgets that do transportation. So this is something, even alcohol today and tobacco are really done at the state level. So we believe like interstate commerce won't come so quickly. But having said that, what are we doing to prepare for that? So we at Jushi focus our grower processor facilities primarily, exclusively right now, on indoor grows. We believe that indoor grows are no more competitive outside of in states like California, I think what you're getting at, or Oregon. We don't believe they're any more competitive. Well, I don't believe real estate taxes are less. I don't believe the cost of land is less. I don't believe employment costs are less. I don't, taxes are quite high on the income level. I mean, there's really nothing better in California than in a state like, for example, Illinois, or a state like that we're in, Pennsylvania. So we believe our cost structures that we're putting in place are very, very competitive. Electricity is a big cost. It's not cheaper in California. In fact, it's higher in California. All of those costs are higher in California. So we don't believe that on the indoor grow side, which is where the higher quality product is grown, which is a segment that we choose to compete in, that you'll ever have this redundancy take place. Where the redundancy will take place is more in stuff that is dependent upon the outdoor grows, and we're sort of set up for that. Over time, we believe that they won't ship flower, but they'll ship oils, which we'll be able to process into vape carts and gummies in our existing facilities. So that's just a matter of, us, for example, the people who might be exposed to that are people who have outdoor grows in Maryland or outdoor grows in Pennsylvania, or people who do these lower level greenhouses in these states. That kind of stuff will become uncompetitive, in that environment 5 or 10 years out. Jushi chooses not to, do that. We also have a California strategy. We have a retail strategy there. We're very connected into the culture there, grower processors. So we may, over time, it's very distressed out there, the grower processor land. Those preparing for interstate commerce by getting involved in grows in California have done nothing but suffer dramatic losses and black eyes to their strategic plan and their management teams. We at Jushi went retail only in a very small way because we feel like over time you need to be involved in California. We thought this was a low risk, smart way to get involved and get into that business environment and regulatory environment. And over time, if we see things, the winds shifting, we may be able to get involved in an inexpensive way in these sort of interstate aspects. But we're years away, and the values are coming our way. But at some point, maybe we'll do that. We'll see where things go.
Is California going to be a main revenue driver for you? I'm curious. I've heard about direct to consumer sales and how that may impact retailers if that goes through, and what your feelings are on that, as well as other revenue drivers that you have, because you have a lot of brands. You have Beyond Hello, Nira, the Lab, the Bank, Tasteology, Sesh. So the Beyond Hello, that's your dispensaries. Nira's, that's the base cannabidiol.
Yes, yeah. So the Bank is flower, higher end flower. Sachet is sort of lower end, and then you have Lab as our or extracted products, mostly known for the vape pens. Tasteology's gummies and Beyond Hello. Nira is medical, smaller area, and then Beyond Hello is our retail storefront. And so so in California, direct to consumer, I don't think that's happening anytime soon. We do delivery out of our dispensaries there. I don't believe California is big right now for Jushi. It's quite small, just a small single-digit % of our revenue. Small low single-digit % of our revenue. We expect it to maintain that level where it's something very small at Jushi, kind of more like an R&D project for us. We don't think it's a big money-making or growth opportunity. We do believe, we're known as having skills of doing value-oriented M&A deals, restructurings. I was brought up doing distressed investing in the hedge fund world for multi-billion-dollar hedge funds, which I helped to found a couple. We have the capability to pounce on it once we feel confident there's an opportunity there. But now it's going to be a low level of upside in Jushi and a low level of downside in Jushi, a very small piece of what we do, which has been a very smart move so far, by the way.
Talk to me about the distressed opportunities. Having done that on Wall Street, where you mentioned California specifically, but Oregon is pretty bad. I would assume Oklahoma is going to be bad with 7,500 licenses. Washington State's got its own petri dish experiment where I'm at. So I think there's going to be a lot of distressed opportunities, maybe. What is your professional opinion on the hedge fund side, looking at some of these distressed assets? Is that an opportunity, or are they just going to kind of?
Yeah, listen. The big game is California. Washington State. The laws aren't great from what we would want. Oregon, the ditto, and Oklahoma. I think Curaleaf just exited. It's nothing we're interested in. So those regulatory structures are so poor, that there's no real reason for us to focus. And there's other environments that have so much growth, and the industry requires so much capital to grow, including Jushi, that we have to allocate capital. We have more deals, more good deals, more growth opportunities than we can fund. And the same can be said of every company out there in the top 10 MSOs, the publicly traded MSOs. So which is the only one people should really focus on, in my view. Investors should focus on. And so there's no reason to go into those states that you mentioned, in my view. I think any MSO that's there, those top 10, would call that right now a learning opportunity, maybe R&D, or maybe a mistake, depending on honest with themselves that they are. At one point, I thought California, we would have 10, 12 dispensaries by now, but we realized how difficult that environment was. We pulled it back to turn it into, we picked up in California. Every deal we did in California was a very low entry price. We bought a dispensary out of Men, when they were already distressed for cash, $3.5 million, considered distressed purchase. We bought there was a family that was in transition because of some poor health of its founder, and we picked up a cheap dispensary in Palm Springs that way. And then there was a battle in Santa Barbara between the landlord and an underfunded operator who couldn't get the dispensary open, and they may have lost it if they couldn't get it open. We stepped in and solved that problem. And so all of our deals in California were distressed when we did deals, but we put the pause button on it, did no more. It's really the way to focus in the opportunities are so big in our states like Pennsylvania, Virginia, Illinois, Ohio. There's no reason to focus our management and capital resources in the states that you mentioned.
Going public, I would imagine, is also a learning experience as well. You guys are publicly available under the ticker symbol JUSHF on the OTC markets. Having gone public, 6 to 9 months before the height of the pandemic, wow, it's probably another opportunity in and of itself. Do you have any learning lessons or what have you learned since going public?
Well, I think Jushi was very well positioned to go public from a management team perspective. I had run multi-billion-dollar hedge funds investing in public securities and private securities, companies going public, company transitioning from being public or transitioning to being public, or very liquid public securities. Because of that, I well understood all the laws and the regulations of being public. We have a very large corporate staff on the legal side and the financial side to be able to handle that. So we were very well positioned, a little small to do it, I would say, but we were kind of forced to go public because of the way there were some regulatory exceptions for owning licenses in Pennsylvania, Illinois, that sort of forced our hand to go public. So I would say that you better be prepared for it. I think of a lot of companies even in the top 10, the top 10 MSOs, didn't do it the way that, they may have kind of not understood what they were getting into and underestimated how difficult it is. You need a big IR machine. It's very retail driven. There's a lot of things you need to do to be a successful public company. Big corporate legal staff. You need to have you need really good advice on the outside. And I do believe that there's been a lot of mistakes made by MSOs going public. Certainly outside the top 10, virtually all of them, shouldn't be public in my view, or, you should really be, really have to examine what their business strategies are in my view. But, and when I say 10, it could be 12, it could be, the top 12, whatever. I don't mean just 10, but it's about that, right? You could debate 2 or 3 different companies. I just want to be clear on that. I'm not, but yeah, I think there's a lot of companies that weren't prepared. I think a lot of companies, I think the ones who went public via SPACs have had very real difficult times adjusting. One of those companies, Columbia Care, was just sold to Cresco. They never traded well. It's very difficult in cannabis to manage a shareholder base that you didn't know, that you didn't home grow, that these are people that know you. Very difficult to take a bunch of random people and turn them into stable shareholders. So I think there was a lot of lessons learned, and I think there's a couple of companies out there that have very decent asset bases that could very well be public, but I think they backed off on the process because they've started to understand how difficult it is.
Mm-hmm. I've noticed there's a lot of companies that initially got into SPACs that are no longer offering those. A lot of these big banks are no longer in the game of SPACs.
Yeah.
And those that did go that route maybe didn't have the compliance. There's plenty of cannabis companies who aren't ready for that compliance step. What advice do you have for companies that are maybe looking at exit strategies of going public without doing their due diligence? It's an expansive opportunity, but yet there's a lot of compliance around it too. So there's advantages and disadvantages.
I think in the cannabis world, I'd be surprised if there's another, they call it, once you have the money raised, it's called the SPAC. And then you de-SPAC it to become a regular public company. And I think I might be surprised if there's another SPAC raised to do cannabis. And I would be surprised if any of the existing SPACs actually de-SPAC in a successful way. Maybe there's one. And I don't think it's going to be on the grower processor side. I think it will be in some other version of it. But I could be wrong. I just think I think there, the whole SPAC thing is shattered in tatters in the bear market. Maybe in 6 or 12 months when the market recovers, maybe there'll be something that happens. But for the next 6 months, I don't think that's going to happen. But I could be wrong. But if I'm wrong, it's going to be there's one that gets done, either a SPAC or a de-SPAC. And there's only a few out there right now focused on cannabis. That's my prediction. In terms of companies, advice to companies going public or looking at SPACs, I would say look to partner with existing folks who are already public. Look at it not as a sale, look at it as a merger. You're not going to get a lot of cash if you get any cash. You're going to get stock. Diligence that management team, diligence their asset base. Be realistic about what you provide that company in terms of value, and what you get out of them in terms of value. So said another way, there's a lot of unrealistic sellers, have been a lot of unrealistic sellers over the years who've kind of missed the boat and probably wish they've sold earlier. A lot of these folks are getting pressure from their lenders and they're getting pressure from shareholders to find an exit. It's obviously not an opportune time to do that in this market, the stock market. And I would say that, if you think you're going public, I would say you're not. And if you think you're going to get into a SPAC, you're not. If you want to get some liquidity for your shareholders, you ought to think about being realistic on price and understanding that you're not selling. All you do is trading what you have for trading what they have, and you better have a good management team in place because this is a tough industry. And I think there's tons of opportunity, and shareholders do very well in the long term or even the medium term. But be careful about who you choose as your partner.
When you were talking to investors, what was your pitch for how you were going to have a direct path to ROI?
That's a very good question. I've always talked about the long term. So if you look at cannabis, we still are in the extremely early innings of cannabis. It's not anywhere close to being federally legal. There's a bunch of hurdles on the federal level. There's a bunch of great states that aren't even, you can't do business in, that are not legal. There's a bunch of state programs that we are all involved in that need some significant improvement to be economic. So it's very simple. I'll say what I'll say. I'll give you an example of things that I've said. If you look at Amazon, Amazon, which is clearly one of the best companies that's ever been built in the face of the earth, right? Nobody who bought Amazon in 2005 was looking at the numbers of 2005 or 2006 when they were purchasing that stock as the reason that they were buying that stock. They were looking at what was going on, the growth levels over the last 2 years in the number of prime customers or the number of customers. They were looking at retail, online retail as a total percentage of where it would go. And they were looking at Amazon over a 5 or 10 year period, right? And they were betting on Jeff Bezos and his management team and their first mover advantage, right? And so that 5 or 10 year time frame is what it was required for you to actually commit significant capital or any capital to Amazon at that time. I would say if you're an investor in cannabis, you should be looking for the winners, the smartest, the most capable management teams with very strong footprints, and look at the business over a multiple year period going forward. Don't focus on the next quarter or two. Don't focus on the next year or two only. Look at 5 years out, 7 years out, that time frame. And that's how you're going to win. And I think some of the issues that people have had investing in cannabis is it's such an easy concept, right? Who doesn't? I mean, the product's great, right? It's been used for hundreds of years as a product, and it's more popular than ever. It's safe, when done in moderation, and when people have knowledge, just like any product that you use, whether it's a pharmaceutical product or alcohol or tobacco or it can be safe if you use it or safer if used certain ways. So I think, but people said it's so easy, I can invest anything and anywhere, and they just did it, right? No, back up. It's just like the .com boom, right? When people who were investing in 99 and 2000, there was a lot of winners, there were a lot of losers, and just a few winners. And in 2004, 5, that's when people noticed who the winner was: the Amazons, right? The Apples, the Facebooks, who wasn't even public back then, Google, who wasn't public back then. Like, those were the big winners. Okay, so in cannabis, I think people are getting a sense who the winners are. There's a lot of consolidation going. Focus on those top, 10 companies. Focus on the ETF, MSOS, to take out some of the risk. I think Jushi is a great company, but you really need to look at it the long term and focus on great management teams.
Is that what you're focusing on when you're looking at M&As? Obviously, they need to be creative. They need to be a strategic partnership. But is it management or is it EBITDA? When you're looking at M&A opportunities, is it just an opportunity with distressed assets and low valuation?
Remember, I'm not a retail shareholder. I'm not a shareholder. I'm a very, very sophisticated. I'm probably one of the most sophisticated investors and operators in the business, right? If you think about it, I have a 25-year, long-term, positive track record investing in highly complex securities in the hedge fund world, right? And then I've taken that and I've been investing in cannabis now for about 7 years, something like that, right? And I've been an operator in cannabis for over 4 years, right? And so when you combine all that, what I do, how I'm doing it, and I have an operating business with a management team. So what I'm doing with that is nothing like what other investors should be doing. We are not looking at the management teams we're buying for all of the time. Do we like to get some skills with that management team? Yes. Where do we typically like to get those skills? On the cultivation side, we could always have more cultivation talent. In the grower processors, for the people who handle the product after it comes out of the flower room, we call that post cultivation. Post flower room. That's a very nice skill we'd like to add to. But for the most part, we don't need almost anything else. We always like to get more management. We're definitely always looking to build our management team, but it's not required. When we're looking at acquisitions, we're looking at which state it's in. How does it fit into what we have? We look at the market it serves, the growth opportunity. We're kind of looking at more as a license. And then if it has a facility, how is the facility built? Is it a Gen 1 facility? That's not great. I call some of them Gen 0. Definitely not good. Is it Gen 1 to 1.5? That's probably the best you can do. We're doing like what I call Gen 3 facilities right now. That's state of the art. So, that's for a grower processor. For retail stores, when we do that, is how much capital do we have to put in to get it into what a Beyond Hello it looks like, what our vault space looks like, what our express lanes look like, what our parking looks like. A grower processor, do we have to buy more land around it to get to the max scale that we need? Those are the kinds of things we look at, not the management. The management is great. We love I call it accretive talent deals. Love it, but it's not like we need that. We bring a massive talent. We have 1,500 employees with a large staff in Denver who has tons of cannabis expertise. Now the cannabis expertise is throughout the country. We have great, cannabis expertise in Massachusetts. We have the great cannabis expertise in Pennsylvania, Virginia, etc. So you know, we're looking at the state and the facilities in that state for the most part.
And for anybody who wants to take a look a little bit more in depth about Jushi, they can find you in the OTC markets under JUSHF. Where else can they find you at, Jim?
Well, listen, Jushi has a huge online footprint on our website. You know, our investor relations team does a magnificent job of putting up all kinds of information, including Jushi TV. So if you go to our website, you can get Jushi TV. We have a section that is to investors, and you can hear me talk in depth and other people in the company talk in depth about particular areas of the company. And even if Jushi isn't your preferred investment vehicle, or you just want to learn about the industry, it's a great resource to learn. I hear other competitors of ours, they've told me this, but I've heard it that, you know, think what we're doing at Jushi TV is amazing. So these are videos designed to educate future employees, potential investors, existing investors, regulators, you know, whoever it is, on what we do. And it's very curated. So you can go do a short video, long video. You can do retail. You can do grower processors. You could hear me talk about markets, wax poetic about whatever I think I'm so smart on. Whatever it is, you can find it in there. And I think that's the best way to really diligence Jushi and the industry.
Okay. With that, I think we're gonna have to wrap this one up. So I want to thank my guest, Jim Cacioppo, founder, CEO, and chairman of Jushi. Jim, thanks again for being with us at CEO Interviews.
Thanks, Josh. Thanks for having us.
Appreciate it. I'm Josh Kincaid. This has been another CEO Interviews by Seeking Alpha. Don't forget to like, share, and subscribe. Thanks.